Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
God, you've got someone in the heart of Texas, Softeq Venture Fund, Chris Howard.
Yeah, he's a great guy and with an amazing track record and a really unique approach to how he not only invests, but he uses his venture studio to build these technology companies.
Yeah, I'd heard some about this venture studio model, but I hadn't really heard it in the way that he describes it and the way that he uses it. And I think it's very unique. And, most importantly, I think it's really good for the LPs and other investment partners. Like, I think that's the most valuable thing that he's going to say and tell us about. But I think that's really the key.
Oh, absolutely. Because the venture studio concept is not new, but I think Chris has a unique take on it because he has basically helped some of the largest brands and companies in the world on their technology. From Disney to major studios, major sports leagues and teams. So he knows how to build tech, and he spent his career doing that. He actually just mentioned the other day that they celebrated their 28th anniversary. So obviously he's got an adult-sized business. And the great thing is that he decided to take his technical know-how and then invest along the way. And so again, you are not just getting a passive investor saying, contact this technology development firm. You're getting, I have a technology development firm. Let us build your tech too.
I know, fascinating. Well, let's hear from Chris Howard, Softeq Venture Fund, Houston, Texas.
Hello, everybody. My name is Scott Kelly. I'm the founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. Welcome all of our listeners today, and I'm really excited to introduce a really undiscovered but very important person in the venture capital ecosystem, Chris Howard of the Softeq Venture Fund and Venture Studio. Welcome, Chris.
Thanks, Scott. Great to be here.
Awesome. Well, Chris, obviously you've been doing what you're doing for a long time, but before you started the fund, share a bit about your professional experience and how that led you to starting the fund.
Sure. Yeah, so Softeq development is actually 28 years old today, which only apparently 5 to 10% of the companies get to 28. So we're about that. But it's a full stack hardware and software engineering company where we do, hardware, firmware, mobile, web backend, AI, ML, data analytics all under one roof. So a lot of IoT connected devices stuff. Doing a lot of work for the Fortune 500, doing product development for innovative entrepreneurs at companies like AMD or Epson or Disney, et cetera, right? And then we had a steady stream of innovative entrepreneurs coming in that needed products built. And if they had the money, we would do the work and build their product. And if they didn't have the money, we'd have to send them away, tell them, go get some investors, talk to somebody like you, get some money, come back, and we'll build it. Or I'd do an angel investment or something like that. So sometimes cash, sometimes services. And that was working out pretty well. And so I thought, maybe formalize it and raise a venture fund and, kind of pick from the top 3% of companies coming in our pipeline anyway, and actually give them some funding. And then we decided to also put them through a studio where, say, we give them the mentorship. So basically combining that funding with some mentorship and then pair them with our 400 engineers to help them get their POC built or their MVP built or get their hardware software more enterprise ready, like we've been doing for the Fortune 500. So basically it kind of came out of, my engineering side kind of organically, where we just had this deal flow coming in of startups that needed not just money, but, help building.
Yeah, that's a really great concept. Obviously, the venture studio model has been around for a little bit. Maybe share how your venture studio and obviously how you differ from other folks out there, because obviously there are 3,200 venture capital funds. A lot of them just invest money and maybe do a quarterly call. Kind of maybe share how you are more actively involved in not just making the investment, but making sure these companies have a high probability of success.
Sure. Yeah, good question. Yeah, a lot of, like you said, a lot of venture funds, they write the check, throw the money over the wall and kind of, cross their fingers and try to be sometimes smart money where they're like, hey, maybe I've got someone in my network or investor or something like that. we try to be the ultimate smart money with by helping them actually build and mentor, right? And so there's a lot of different, say, people running under like a so-called studio model. There's some that basically come up with the idea, hire a team, incubate it, and then put it out in the world. Our model is really more like a Y Combinator accelerator with an engineering arm, right? So a lot of accelerators will help a startup founder with their legal and their cap tables and their go-to-market and their pitching and how to put a pitch deck together and how to do an elevator pitch, and all that stuff's needed. But what we do in addition to that is like, well, let's get a look at how have you structured your mobile app? Do you know where your source code is? Do you know who owns your firmware? It used to be 9 out of 10 founders had a technical co-founder, but now 9 out of 10 don't. I mean, the millennials and Gen Zs, they all are very comfortable with technology and they have the ideas around it, but they don't necessarily know how to program it. And so we come in kind of as that trusted CTO, and this de-risks the investment for the LPs because, essentially bolting on a small team that may have never shipped a product before with a much larger organization that's been shipping products for 3 decades, and can help them avoid all the mistakes that they typically make and take a look at how they do their source control and how they do their versioning, how to do their cyber security and stuff like that. So it's like what I call is like the ultimate smart money because we understand software and hardware, right?
That's a really good point because I talk to, like you, literally hundreds of entrepreneurs a year who have a great idea and they have little else. Maybe they put together a pitch deck. But they wouldn't know how to build the technology. So I definitely track with that. So when you're looking at companies to invest, what kind of things do you look at from the entrepreneur standpoint?
Yeah, I have a good friend, Ben Narrison from Tenacity, but he says he looks for 5 things, and I agree with him, right? 5 things: founder, a great idea, and a huge market, right? And so you really do look at the founding team, and that's another thing that happens when we get to work with the founders for 4 months in the studio. You really get to know them versus just trying to vet them out with a few phone calls before the studio, and then you know whether to do follow-on investments and things like that with the founder. So definitely founder is a huge piece of that. Are they coachable? We try to get that out in the call. Do they take our feedback? How receptive are they to that? And you can actually tell fairly quickly whether this guy actually is listening, or gal, of course, because we invest in a lot of diverse founders, but the founder for sure. And then for us, it's, can we help this company, right? Are they building hardware or software? I mean, if you're a CPG company and you've got your liquid death or whatever it is, unless you need the back end or some mobile app to go along with that, we're not going to be able to help you. I don't know anything about CPG. And, I'm not going to, maybe it's an SAP plugin or something. We're not really big on SAP. But if it's technology, hardware, software, tech, and we can help them and then also connect them with our network of Fortune 500 companies because we know what they're looking for, right? So that's what we're looking for when we're picking basically that founder and whether we can actually provide value to them, and both from the building and from the network.
Now, that's a really interesting point because obviously not only are you providing them capital, helping them build their technology, you're able to rely on this network of these Fortune 500, Fortune 100 companies that you could probably look at a company and say, you know what, this previous Fortune 500 company or current Fortune 500 company would be a great partner or could be a great purchaser of their technology. So
I mean that happened even in the very first cohort. We tested the model with 5 or 6 companies in cohort number 1. And one of those companies was building it was a medical application for surgeons in the operating room, more targeted toward transplant surgeries because you need to have a representative in the room from the transplant, make sure the doctor doesn't put it in upside down or whatever, right? But they were using like the Epson Moverio headset, and Epson's a client of ours, and we also have built applications for that Moverio augmented reality headset, and then we can facilitate a meeting between them and Epson and say, hey, here's a technology or a startup using your product in a way maybe you didn't even contemplate. This might be of interest to you.
So I'm glad you touched on that, because obviously you've had some great track record with these Fortune 500 companies, but you've had some good luck and some good success. Let's not call it luck; let's call it success with some of the portfolio companies. So
There's always
why don't
some
you
luck involved.
why don't you share some of your success stories? I know a couple, but
Yeah.
share some of the highlights.
Yeah, sure. Well, I mean, the poster child for our fund really is an angel investment I made into a company called Halo Collar. They're a connected dog collar. These guys, we talked about founders, right? So these were brothers, one's like the CTO, one's the CEO, but they had already created an asset tracking company and taken that company public on the New York Stock Exchange. So I really like the founding team. They've already been through the process and gone through the school of hard knocks, and they're like, we want to create a $1,000 dog collar with a monthly subscription. And you think like, well, that's a little bit crazy. But, I looked at, well, the founders check the box, hardware and software technology. That's something we know something about. Let me make an angel investment in this company. I think I put $250K in at a $15 million valuation. And then, we went off to the races. And this particular technology, the ROI, when I'm thinking about it, they said, well, explain to me why someone would pay $1,000 for a dog collar. Well, a fence costs $5,000 or $10,000 or more to put in your yard. An invisible fence also costs $5K or more to put in your yard. The dog can still go over, under, or through that fence, and then you still don't know where your dog is. And those products, neither one of them are portable. Well, with the Halo collar, actually, just coincidentally, I do have it on my desk here. Here's version 4. So fast forward, they're going to do 100 million in revenue this year, and they're a unicorn. They're probably valued at 500K, and so that model where we're looking at, if we had the studio at the point in time when I came across them 4 years ago, they absolutely would have gone in, and that investment alone would have paid back the venture fund, right?
Wow.
Because of we typically get about 6 to 9% of a startup that goes through the studio, because we give both the studio mentorship, and then we give each startup a 125K convertible note, usually split 50K in cash, 75K in services to help them get that product built and everything. So that's one of them. Halo collar, definitely a unicorn. We've got another I can't really announce publicly yet. It just got an external investment from a venture capital firm. They led a round of $3.5 million. They put in $2 million of their own money. About half of our companies that have gone through the studio have gone on to raise additional money, which to me means that we're picking the right companies because they are getting funded. And also in this climate the last 2 years, there's been very little in the way of funding, right? And so we are getting traction. A few others like Mallard Bay, which is like the Airbnb of outdoor sports. Like if you want to go duck hunting or fishing or something, you can go on their platform and find a reputable guide and facilities and place to hunt and stuff like that. What's been interesting is that we've attracted startups. I thought they would mostly be in Texas because we're in the Texagon of Houston, Dallas, Austin, and San Antonio. But we've attracted them across the United States and also across the world. We've had startups come through from Israel and Bahrain and Canada and Mexico, Kenya. So it's the world is flat with the internet, right?
Right.
So
You
definitely.
You touched on what's happened over the last couple of years. Why don't you share with us your analysis of venture over the last couple of years and where you see it going? Because obviously liquidity has been a big issue for a while. So why don't you kind of share where you think the industry is going, from that standpoint?
Yeah, I mean, it's definitely been true. It's been, speaking of emerging VCs, right? I mean, it's the worst time to raise a venture fund in 10 years, but there's a lot of opportunity out there. I mean, this vintage, like in 2008 when we had the downturn, that's when the Airbnbs of the world and everything. So there's great companies out there at reasonable valuations that you can invest in, where you're not overpaying for equity. There's definitely a lot of interest around AI, and there's a gold rush around that. LPs are a little bit beat up because there haven't been markups, there haven't been exits. Even experienced venture firms are saying we're pushing off raising fund 4 or 5 right now because of the climate. And you're like, wow, if you can't raise fund 5 and you've got these 4 funds full of LPs, then it would be a challenge for us to do that. But the statistics are, that emerging managers outperform other venture firms. You've got A16Z and these others, they're sucking up a lot of the capital. But as you can imagine, how do how do you 100x a $5 billion fund or whatever the heck they're raising? So generally for LPs, looking for an emerging VC that knows their space and has unique deal flow and can make more vested evaluated bets on these startups, as you can imagine, can outperform a larger fund. And then also, because of our model, we're acquiring equity for a lower cost because of the studio, because the startups understand the value that we're providing by partnering with us. And so that also allows for more outsized returns. I'm starting to see in 2025 more interest. Like this month alone, I talked, we had the one big investment with the startup, and then the second one just told me last night they're getting acquired, or they've got an acquisition offer on the table. It's more of a equity, basically we'll have equity in the acquiring company, but still positive outcome for that. And so I'm seeing more deal flow there. So I think things are opening up, and hopefully we'll get some liquidity from the other LPs that have invested in other venture. I think that if I can touch on, basically LPs, a lot, even in family offices, they don't necessarily understand venture. They're like private equity, PE guys. They understand that it's a 10 to 12 year kind of horizon, and that, the first half of the fund's life, you're typically negative in your multiple, because what's happening is companies are like going out of business and your winners are surviving and thriving, but the big returns come in later. Probably we need to add another year or two on the life cycle because of what's happened in the last 2 years in the economy. And so people just need to understand the power law of venture, right? You're looking for those few companies that are going to turn your fund, 100x, and return the fund.
And I'm glad you mentioned that, because the reason why we have this podcast is we talked about this before we were recording, is that there are 3,200 venture capital funds, 1,800 fund ones, and the reality is the vast majority of the capital goes into these huge monolithic funds. And you already mentioned is that the returns, the alpha is far better, managing a real fast boat versus a massive tanker. And and so I'm glad you mentioned that. So maybe share a little bit about the profile of your current LPs, and what kind of LPs would you be targeting in this fund?
Sure. Yeah, I mean, the challenge with an emerging fund and fund manager is that often, the institutional investors won't invest in emerging VCs because they still do, despite the statistics, right? They still view it as more of a risk. And then they also mark you as an emerging VC. Many of them will say you're emerging if you're fund 1, 2, and 3. So you talk to them and they're like, well, come back to us in 10 years, basically, is what you're saying, right? Because by the time you do a 2 or 3 year raise and deploy or whatever, and then you fund 2, fund 3, is like, oh, you're going to invest in fund 4? Not all of them, but many of them do. Hey, come back in fund 2. Or, some of them are like, well, we can't be more than X% of the fund, and you've got a 5 or 10 or $20 million fund. In our case, our fund is a $40 million fund, but still, even 40 million, they're like, well, we can't, our check size is such that, we can't write a $10 million check into your fund, because then we're overweight in your fund. So come back to us. And this is why in the cycle, you end up raising larger and larger funds, because you're trying to get access to those larger, institutional checks. For us, I think most traction, of course, has been, we have about 30 LPs in the fund. So family offices, high net worth individuals, maybe entrepreneurs that have exited their businesses and now want to not just give back, because it's not philanthropy. I view this almost like philanthropy with an upside, right? Hey, how do I help other startups get off the ground? And some of them want to be involved in like the studio and giving back from their experience and mentorship and perspective. And so that's been our model. Our largest family office committed 10 million, as long as they're not more than 25% of the fund. And we've had check sizes ranging from, I think we've gone to as little. I mean, we try to keep it more like individuals at the 100 to 250K or more level, and then others are 250, 500, a million. Yeah, trying to find. I think that's one thing emerging managers need to focus on. Find your persona, who's interested in the type of fund you have, And for me, it's more like, well, we're a technology software hardware company. So these high net worth individuals that were in the technology space, that would have, liquidity, that want to get more exposure to venture. Second thing for emerging managers is really, like for me, if you're a family office, you're not going to pick Halo Collar and some of these others directly because you don't really know how to evaluate them. So if you want exposure to like the tech space outside of maybe your real estate portfolio, but you're not going to, vet these companies individually and make individual bets like in roulette, be like straight up on the number or whatever. You should really invest in an emerging manager that knows that space and can make more of an informed choice and has the deal flow, and and just invest in the fund and get a wider swath. Like in our case, we're going to have 60 to 100 or more startups in the portfolio, so that power law happens. So that's what we've been targeting.
So I'm going to touch on the subject in a minute, but you mentioned deal flow. Obviously, it looks from your results you're getting some great deal flow. How are you getting that deal flow?
Yeah. Well, we have a little bit of an unfair advantage compared to someone who just decides they want to be an emerging manager, because of Softeq being a worldwide business and being around for 28 years, and companies Googling for technology, software and hardware development. And so they're coming to us through that channel. Mm-hmm. And so we get, I don't know, 100 a month from that, where they're, but many of them we've, from a services standpoint, we would disqualify because, we're not going to do a project for, less than 100K or something, especially for a company that maybe doesn't have any credit history or, might not be around. So, from a strict services standpoint, we wouldn't have normally engaged with those. But with the venture fund, we have a model to where it'd be like, well, since you don't have funding right now, or you need additional help, you're a good fit. Why don't you go ahead and apply to the studio? Mm-hmm. And then if you make the cut of being the top 3% or whatever, then, we'll do a cohort of 10 to 20 companies, and then we'll engage Softeq services, working for them when we normally wouldn't have, to help them grow and scale into, potentially a client for Softeq. So services business is happy, but, it's, so we get the deal flow from the startup perspective, and then, things like podcasts and other things where they get to see like what we're doing and getting more known in the space, and they're Googling for studios and mm-hmm. where they can get additional funding. And so we've had a lot of, like I said, surprising thing is that we've had companies apply from all over the world finding us, even though we weren't necessarily doing that. I think that's partly because of Softeq's global footprint, right, but partly because, in Google, you can find anybody, right?
Sure. I mean, it's interesting. Obviously, that the 28 years of building companies makes you uniquely, qualified, to make informed, strategic investments. And I'm going to go back to the investor side of it. You mentioned family offices, and let's talk about high net worth individuals. I work with a lot of registered investment advisors, and they're obviously looking for alternatives and other opportunities to increase their overall return, for their clients. And obviously, they can attempt to beat the S&P or the averages, maybe look at some individual, private equity allocations, if they can get them. Talk to an RIA or an advisor who is going to be recommending alternative investments for their clients, and why a venture fund, and more specifically, why your venture fund as a recommended opportunity.
Sure. Well, I mean, I think, as a portfolio, it makes a lot of sense to have some exposure to venture and tech. What I've been surprised about is that a lot of family offices, they do want to stick to like, oh, we know real estate, right? Well, that's great. No one's saying to bet the farm on venture and technology, but you've seen the types of returns you can get on the West Coast. And, a lot of VC firms and a lot of startups are focused there, but there's been a lot of great outcomes of that. And so I saw a statistic recently that if you ask the question, well, what do you think some of these institutions invest as a percentage of their portfolio into venture? Most people will say 2% or less, right? Because venture is risky, right? But surprising number is it's more like 40%, right? And these are pension funds, right? These are those types of, institutional investors. And so family offices don't have anywhere near that exposure to venture. And so if you want to get more of that exposure with, like you said, not having to like set up a team to evaluate whether a particular pre-seed or seed startup is investment worthy or not, then it makes a lot of sense to partner with a venture fund that has that deal flow, looking at a lot of companies and deals and knows how to evaluate them, and then can then help them actually grow and scale, versus just throwing money into a venture fund and there's an ex Morgan Stanley guy that's trying to decide whether he puts money in. So there's this debate about whether VCs should be really more coming from wealth management or really coming from owner operators. Of course, being an owner operator, my bias is like,
Sure.
I think that gives us an advantage where we can, for most people, technology is like Asimov, right? It's indistinguishable from magic. Do they have any there? And that's where the studio actually helps us get under the hood. Because sometimes we're like, that sounds crazy. If what you're doing is actually works, that's huge. So let's get you into the studio. You sound, like we'll take a percentage of our 20 companies and do like what we call a moonshot. Let's get you in and evaluate it. Sometimes we get in there and we're like, yeah, this, that's not how it works. You don't have anything really, But how does someone, like at a family office, evaluate, a software stack or, a piece of hardware and kind of understand whether it's, bogus or not? Everyone's heard of like what's that one drop blood company? Not One Drop, but it was called something like Theranos, right?
Yes.
Theranos had a huge number of investors in there that had no clue about technology.
Right. Exactly.
Nothing. That's why they were able to be snowed by Elizabeth Holmes, because she could talk a good talk, and it all sounded cool. But if she had a partner, or if Softeq had gotten in there to take a look at it, we would have quickly said, yeah, no, it just doesn't work. This one drop of blood there's no way you can run this many tests and stuff. So that's where you protect the LPs. And so that's, I think, the value that we offer is that we're stamping the Softeq name as like certifying basically this is a company that can be invested. And because of the studio, it's almost like paid due diligence, So we'll make our initial cuts, we'll say these 3%, we'll put them in the studio. After 4 months, we absolutely know the founders and their tech. And we can say, now this is the top 2 or 3 that we want to do a bridge round or do a lead an A or something, or a seed round.
Right.
And this is where we should really double down on the money. And we might be wrong on the rest of the portfolio, but we've got stock, right? So our anti-portfolio on the cohort, we still have upside. Oh, we didn't think they were going to be very good. It turns out they were, and we still have 6 to 9% of the company.
Awesome. Anything else you want to share with our listeners today?
Yeah, I think that, if you are a high net worth individual or family office and you do, you're not really exposed to any venture, I think that you do want to find some emerging managers like yourselves, and maybe it doesn't have to be the tech space, maybe some other thesis. Every emerging VC has a thesis of what they're investing in, and allocate some percentage, of what you're putting money into. You're going to keep your majority of your portfolio to your core of what you know, but maybe you don't understand tech, but you want to get a partner in there that knows tech, or a partner that knows whatever your med tech, sports tech, whatever it is that you're investing in. AI, right? You're going to evaluate AI. Well, if you want to get into AI, you need to bring in an emerging VC that's looking at AI deals and knows how to evaluate AI, because that stuff really does look like magic. Part of it is kind of amazing, right? But so I would say, don't be afraid of emerging VCs, because they're raising money and deploying because they really do know what they're talking about in the space that they're deploying capital to, and you can get outsized returns by partnering with an emerging VC like that.
Awesome. Chris, where can people learn more about Softeq and yourself? You're pretty prolific in terms of content yourself, so share where people can learn more.
Yeah, definitely go to softeq.com, softeq.com. You can also see our venture studio there. I have a podcast myself called Forging the Future, where I have guests on the investors and our founders and innovators at large companies and small. But yeah, definitely go to that primarily, and then we're on all the social channels. And I'm a big believer in give first. So if I can help somebody out, the tech question or have a question about venture or investing or a founder or whatever, please reach out to me on LinkedIn, etc.
Fantastic. Chris, thanks for being on the show. I appreciate it.
Thank you, Scott. I appreciate the opportunity.
All right, take care.
I thought that it was really interesting that he's still so positive and interested. And yet he said, this is the worst time for a venture fund in 10 years. And I love that. He's like, but I don't care. I'm good.
Well, he's a builder. He's a creator. And, he loves, building things. You look at his, when he does, we do interviews. We even did this interview. Look at his background. He's got, R2D2 and, video games and other things in the background. He's passionate about tech. And he's passionate about building it. And he's had, a really good track record doing it.
Yeah, many exits. But I thought what it was so interesting is he looks at this as this is an opportunity for a reset. So it's positive for the market. It's going to reset those overpriced investment models that haven't been working really, that aren't delivering. I love how you put it. There's no there. And I think that's so true, right? Right. And so it's gonna help eliminate a lot of that, because if there's no there, then you really don't want to be investing if your dollars are limited right now.
Right. Well, I think the good thing is he gives LPs comfort that he's making smart investments, because first of all, he can BS test the technology ahead of time. Then he can BS proof the technology after he makes the investment. And I think that really improves the odds of success. And the entrepreneurs don't have to deal with a technical hurdle. And the LPs realize that they have legitimate tech and they have someone building it legitimately.
What do you think of this idea that that there's going to be a longer holding of funds, so that there's going to be a longer fund in general? Do you think that's positive for the market in general?
I think it's we're going through an interesting time right now. The traditional model was to do a few rounds of funding and then go to an IPO. That is changing dramatically. You've got a whole network of secondary markets and opportunities for funds and entrepreneurs, to get liquidity. I honestly was just watching an interview the other day with, God, I try to remember, I think it was not SoFi, it was Stripe. Stripe is going to be a multi-$100 billion private company. And in the interview, he mentioned we haven't even thought yet about going IPO. So I think there's obviously other means of liquidity. And the great thing about what Chris is doing is that you think about this, he's built technology for some of these Fortune 100 companies. Now he's building technology for these smaller companies that he can in turn introduce to the Fortune 100 company clients, for either partnerships or even acquisition down the line. So I think, it's a really unique approach that he's built.
Yeah, I think it's so solid in that. And if you think about holding your fund for longer, it gives that opportunity to remove out these flash in the pan models where then the company tanks right after exit or tanks right after the next stage, right? Because they don't have enough there. They don't have enough solid foundation. And then thinking about the tech build, your dollars that you're investing in, that's one of the biggest sucks. It just sucks money to build all that tech, right? So there's economy of that, but there's also, I know I'm building something that's of value. I know I'm building a really good foundation.
And it's obviously not just a capital outlay, it's a time suck for an entrepreneur. If you don't have a real good development team and someone who's managing the process, that's on you. And a lot of entrepreneurs, some of them are great technical entrepreneurs, some of them just simply aren't. And having a conversation with the development team when you don't know what you're talking about puts you at an extreme disadvantage. Chris is solving that problem.
Yeah, I really hope that expands into some of the AI, because many of the AI funds in the investment groups I've been talking to, they'll be like, here's this handful of AI partners. And I'm talking to them and they don't know what they're talking about. So it's really, you're going to have a lot of bad builds out there and a lot of money and time lost, right? And so I really hope they expand, because the Softeq model is just so great.
Well, I think Chris was working in AI before AI was cool. So I don't necessarily see that being an issue going forward.
I agree. And I think that's what I also think is kind of unique, is that he's like, it's just software. It's just a little different level of software, but it's all just software.
Right. Exactly.
Well, what else do we have coming up? Chris Howard's Softeq Venture Fund's been so great. What else do you got coming up? Like who else is coming in with different models?
We've got some really interesting podcasts. We'll have a podcast with celebrity LPs, marketing celebrity brands and investments. We have that coming up. We'll have Better Capital, who's actually in a niche specifically to gaming and gambling, which is a really interesting niche. And we're going to have some interesting funds from outside the U.S. So there's real opportunities there. I mean, there's great growth and great investment opportunities throughout the world. And we're going to have a really healthy mix. Great managers that you haven't heard of yet.
I love that. Hey, the next best. I feel like we were doing like the next great top model or whatever. We got the next best. We got the next best emerging fund manager. Love it. Well, Chris Howard, Softeq Venture Fund, has been a fabulous guest today. I learned so much today. Look forward to all of these next ones coming up right here on Emerging Manager Podcast.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.